crypto has taken the world by storm. In just a few short years, we've seen Bitcoin go from a niche experiment to a multi-trillion-dollar industry. Every day, new investors dive into the market, hoping to capitalize on the next big coin, the next moonshot. But here's the catch. While the crypto market promises massive potential, it's also full of hidden risks that could catch you off guard. You see, crypto isn't just about profits. There are dangers lurking beneath the surface that many investors overlook. Let's take a closer look at the risks you need to be aware of before you invest. Over the past decade, cryptocurrency has exploded in popularity. Bitcoin, Ethereum, and other digital assets have gone from being digital curiosities to legitimate alternatives to traditional finance. With their decentralized nature, cryptocurrencies promise greater financial freedom, lower transaction fees, and access to a new, exciting world of innovation. It's no surprise that investors are flocking to crypto markets, eager to ride the wave of the next big opportunity. But as the market has grown, so have the risks. And not all of these risks are easy to spot. In fact, many of them are hidden in plain sight, often disguised by the excitement and hype that surrounds crypto. Let's explore some of the risks that could impact your crypto journey. First up, let's talk about volatility. We've all seen it. Crypto prices skyrocket only to plummet just as quickly. It's not uncommon for Bitcoin to drop 10%, 20%, or even more in just a matter of days. And while this volatility presents opportunities for huge gains, it also means big losses for those who aren't prepared. The crypto market moves fast, really fast. One tweet, one regulatory shift, or even one unexpected event can send prices spiraling. So, before you jump in, ask yourself, are you prepared for these kinds of swings? If not, it might be time to reconsider your strategy. Next, let's talk about security. While the blockchain itself is secure, the platforms we use to interact with crypto, like exchanges and wallets, can be vulnerable. Hackers know this, and they've been known to target these platforms to steal millions, sometimes billions, of dollars in crypto assets. In fact, in 2014, the Mt. Gox exchange was hacked, leading to the loss of over $450 million worth of Bitcoin. More recently, we've seen high-profile attacks on platforms like Binance and FTX, which have caused investors to lose their funds. The lesson here is simple. Not all wallets are created equal. Using weak passwords, not enabling two-factor authentication, or storing your crypto on exchanges can expose you to serious risks. So, how do you protect yourself? Simple. Consider using hardware wallets and always enable security features like two-factor authentication. A little extra effort can save you from massive losses. Now, let's talk about something that's often overlooked: regulation. Crypto exists in a gray area, where regulations vary widely across countries and even cities. One country might welcome crypto with open arms, while another could impose strict regulations or even ban it outright. This lack of consistency presents a huge risk. For example, a sudden regulatory crackdown can send prices tumbling, as we saw in 2021 when China banned crypto mining and trading, causing a massive dip in market prices. Governments are still figuring out how to regulate crypto, and their decisions can have a huge impact on your investments. So, when you invest in crypto, you're not just betting on the technology, you're also betting on the future of regulation. Let's not forget the scams. The rise of crypto has brought with it an unfortunate rise in frauds and scams. From Ponzi schemes to fake initial coin offerings, ICOs, crypto scams are a serious risk to investors. In 2017, the ICO boom saw hundreds of projects raise millions, only to vanish into thin air. More recently, fraudulent tokens and pump and dump schemes have been used to deceive unsuspecting investors. These scams can be hard to spot, especially for newcomers who might be lured by the promise of huge returns. Always be cautious of too good to be true offers. If a project promises massive gains with little risk, chances are it's a scam. One of the biggest differences between crypto and traditional financial markets is the lack of consumer protection. In traditional finance, there are laws and insurance protections in place to help protect investors. In crypto, however, these protections are limited or non-existent. If you lose your funds on a crypto exchange, there's often no one to turn to for help. There's no FDIC insurance, and in many cases, no recourse for recovering lost assets. This means that if you make a mistake or fall victim to a hack, you're on your own. That's a harsh reality of the crypto space. And then there's the issue of irreversibility. In the world of crypto, once a transaction is made, it's final. Unlike traditional banking systems, where you can dispute charges or reverse payments, crypto transactions cannot be undone. This is great for security, but it's also a double-edged sword. If you send your crypto to the wrong address, there's no customer service line to call. The money is gone, forever. It's crucial to double-check every transaction, especially when transferring funds between wallets or exchanges. Let's take a look at some real-world examples of these risks in action. Remember the Mt. Gox hack? Over 850,000 bitcoins were stolen, and while some were eventually recovered, many investors lost everything. Then, in 2022, we saw the collapse of FTX, one of the largest crypto exchanges, which went down amid accusations of fraud and mismanagement. Billions of dollars of investors' money vanished, leaving people questioning the security and stability of the entire industry. These are just a few examples of how these hidden risks can have devastating consequences. So, how can you protect yourself in this unpredictable landscape? First, always use a secure wallet, preferably a hardware wallet. Second, diversify your investments. Don't put all your eggs in one basket. Third, stay informed on regulations and avoid investing in projects that promise unrealistically high returns. And finally, don't let emotions drive your decisions. Fear of missing out, FOMO, and overconfidence can cloud your judgment, leading to poor investments and unnecessary risks. Stick to your strategy, stay cautious, and never invest more than you can afford to lose. Crypto may be a revolutionary space, but it's not without its dangers. Understanding these hidden risks and taking steps to mitigate them can mean the difference between success and failure in the crypto market. So, before you dive in, take a moment to evaluate the risks, arm yourself with knowledge, and think about your long-term strategy. Because the real key to success in crypto isn't about chasing the next big coin. It's about managing the risks that come with it. If you found this video helpful, hit that like button and subscribe for more insights into the world of crypto. And let us know in the comments, what risks have you encountered in crypto and how do you protect yourself? Until next time, stay smart, stay safe, and happy investing.